What's going on with Warren Buffett? Since 2021, his cash position has grown significantly, with reserves nearly doubling over the past 3 years. Today, Berkshire Hathaway sits on a staggering $277 billion in cash, creating one of the largest war chests in corporate history. While some argue that Buffett's growing cash reserves reflect preparation rather than a market prediction, it's hard not to speculate that there's more to his strategy. Perhaps he sees what many of us sense but choose to ignore, a market inflated far beyond rational financial metrics, teetering on the brink of a major crash. Why else would a smart investor build up such a massive cash reserve? While Buffett hasn't made any bold statements, his history reflects a simple philosophy: always watch what he does, not what he says, and there's definite truth to this idea. In September 2001, Berkshire Hathaway held just $5 billion in cash. By June 2005, that amount had grown to $48 billion. 2 years later, the market crashed and Buffett swooped in to grab bargains. You could chalk this up to coincidence, or you could acknowledge the pattern. Buffett builds his cash reserves when he believes the market is overvalued and due for a correction. It happened in the early 2000s, and it's happening again in the 2020s. Why? The signs are clear. Let's begin with a simple metric: the S&P 500's price-to-earnings ratio, which reflects how investors value companies relative to their actual earnings. Currently, forward PE ratios show that the S&P 500 is trading well above its historical median, marked by this dotted blue line. Since 2015, following a prolonged period of near zero interest rates and aggressive money printing by the Federal Reserve, the PE ratio has steadily climbed. Today, it rivals levels last seen in the early 2000s, just before the dot-com bubble burst. While it's uncertain how much further valuations can stretch, history suggests that we are venturing into unsustainable territory. Warren Buffett's comment that he can't find any good deals in this environment perfectly underscores the issue. With asset prices inflated far beyond historical norms, everything appears overvalued, primed for a crash to the downside, as it happened in the early 2000s. And if this isn't enough to spook investors, let's take a look at another indicator Buffett once called probably the best single measure of where valuations stand at any given moment: the Buffett indicator. Using data from currentmarketvaluation.com, the market cap to GDP ratio, often referred to as the Buffett indicator, is at its highest level on record, stretching back to 1950. At 209%, it stands more than 2 standard deviations above the adjusted historical norm. This simple yet powerful measure highlights just how overvalued the market has become, offering a clear warning that the current environment may be primed for a correction. With this context in mind, we need to reassess some of Buffett's recent moves, actions that many have dismissed as routine profit-taking or cash building. The most striking example is his recent Apple sales. According to Morningstar, at its peak, Apple made up nearly 50% of Berkshire Hathaway's stock portfolio. A significant portion of Berkshire's growth in recent years was driven by Apple's success. However, in Q4 2023, Buffett sold 10 million shares, followed by a much larger sale of 116 million shares in Q1 2024. Then, in what seems like a shift in strategy, or perhaps even a reaction to market uncertainty, he unloaded an additional 389 million shares, slashing his Apple position by more than half. These moves raise questions about whether Buffett sees deeper risks ahead, far beyond the narrative of simple profit-taking. Warren Buffett rarely speaks publicly, but one notable instance was at the 2024 Berkshire Conference in May. By then, the first quarter sale of Apple shares had already been disclosed, leaving investors puzzled and questioning his decision. Buffett's response during the conference was particularly telling and lays the groundwork for what I'll discuss next. Take a listen to his interesting and bizarre remarks.
We will have Apple as our largest investment, but I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive. And one thing that may surprise you, but almost everybody I know pays a lot more attention to not paying taxes than I think they should. We don't mind paying taxes at Berkshire, and we are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And the federal government owns a part of the earnings of the business we make. They don't own the assets, but they own a percentage of the earnings. And they can change that percentage any year. And the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give, and I think that higher taxes are quite likely.
There are two key takeaways from Buffett's comments about his Apple position, in my opinion. First, he downplays the significance of his decision, implying that Apple's status as his largest holding will remain unchanged by year end. While technically accurate, this framing feels somewhat disingenuous. It doesn't capture the true magnitude of his Apple sales, which likely represent one of the most significant investment decisions of his career. As mentioned earlier, Apple comprised nearly 50% of Berkshire's common stock portfolio. Even after a substantial sale, for Buffett's statements to become untrue, he would still need to trim about 76% of his remaining position in 2024, effectively liquidating it. When Buffett stated in May that Apple would still be its largest holding despite the sales, he made it sound like a routine decision. In reality, it's anything but. The scale of these sales is massive, and framing it as business as usual overlooks the gravity of reducing such a significant stake. We saw that after this meeting, he made his biggest Apple sale to date, selling off 389 million shares, or about 50% of the position post-meeting, and who knows how many more shares he sold in Q3, which is set to be reported in the coming weeks. So what's the reasoning behind Buffett's Apple sale? This brings us to the second key takeaway. He hints that taxes may have influenced his decision. However, I believe this explanation doesn't fully align with his usual decision-making style. Berkshire paid a 21% tax on these profits, but taxes are only due when you sell. There have been discussions about raising the corporate tax rate to 28% under the current administration, but let's remember that Buffett's entire investment philosophy is based on not speculating about the future. Predicting tax rates, especially in such a volatile political environment, seems uncharacteristic for someone like Buffett. In my view, slightly higher taxes wouldn't justify selling off a position that made up nearly half of Berkshire's portfolio. The scale of this sale, combined with other recent sales, suggests that there could be a deeper, unspoken motive at play. When we consider these drastic actions, it ties back to what I mentioned earlier, the absurdity of today's market valuations. By almost every reasonable metric, we seem to be in some kind of stock market bubble. The fundamentals aren't keeping up with the market's performance, and years of consistent double-digit returns are unsustainable. I think Buffett knows this, but naturally, he wouldn't admit it publicly. Thank you guys for watching. I know it's been a while since my last upload, but I'll aim to post more regularly moving forward. I'd really appreciate it if you could take a moment to hit that like and subscribe button. I'm sitting at 197,000 subscribers right now, and I'd love for this video to push me past that elusive 200K mark. Let me know what you think in the comments below. Am I reading into this too much, or do you think Buffett's sales are a sign of something more serious happening in the markets?